Good morning. I am Alex Varner, head of research here at May Management, with this week's market note dated May 16th, 2025, alongside.
Alex Dippery, an analyst on the research team here.
Let's get right into it. There was a lot of macro data last week. We'll start, as usual, with the performance. Broadly higher for the week. I think the only thing in the red was, fixed income down slightly for the week into May 16th. On the full year, you've got the S&P now back in the green with a ripper of a week. It's up 1.4% year to date, so we're back in the green or the blue, depending on how you want to define it, for the year. Big up week. We'll see what brought that. On our recession dashboard, most of the things have not changed. Blue for the most part. Employment is still red, kind of looking for that to potentially deteriorate a bit. People are calling for higher unemployment rate. Keep waiting for claims to tick up. Haven't seen that yet, but we're in May, so we have some time.
Yeah, and that sentiment is something that we continue to monitor closely, as there's been a lot of volatility there.
Yeah, and it's very beaten down, so we think
Yep.
it's going to maybe start to improve and go back to more moderate levels as opposed to the deeply dissatisfied bearish levels that we've been at. On the macro data front, we got April CPI, that is the Consumer Price Index, which came in below forecasts for the second month in a row. It rose 0.22% month over month, which brought the year over year down to 2.33, smallest rise since Feb of 2021. The disinflation story continues. The core CPI accelerated to 0.24, but also slowed to 2.78, and that's the smallest since March of 21. We've yet to see tariffs really coming into these.
Yep.
I think that's coming in the months that we're going to see here. But for the time being, we'll take what we're getting with the cooler than expected inflation numbers.
Yeah, and this is a big deal because, as I mentioned last week, the Fed's made it pretty clear recently that their primary concern has been inflation. So as we see that continue to come down and get some good readings, that might add a little more incentive to cut rates.
And this gives them more room to do so. If
Yeah.
the labor market starts to deteriorate meaningfully,
Absolutely.
they have more freedom to cut rates as inflation remains lower. So that's a good thing as far as their flexibility and their dual
Yep.
mandate. And they can kind of say, hey, inflation is still tamed. We have yet to see anything really changing there, so we can focus on the labor market. We got a similar reading in the PPI, which is the Producer Price Index. Generally, these tend to lead CPI by about a month or so. As you can see, the producers have their inputs and their outputs,
Yep.
and then they pass those through to the consumers a month later. But generally, this thing has been lower than expected the last couple of months. Those also came in well below estimates. The broad PPI was down almost 0.5% month over month,
Yep.
and core was down 0.4, which are the biggest declines since COVID, basically since April 2020. On a year-over-year basis, broad PPI slowed to 2.4 and cores at 3. And the decline was mostly driven by a 0.7% decline in services, the biggest on record. They've been collecting this data since 2009, so that's pretty sizable. And that was mostly due to a 1.6% decrease in margins for trade services.
Yeah.
So that's where you're seeing a little bit of tariffs where businesses are absorbing some of the impact, which has decreased their margins. We'll see if they start to pass that through to consumers in the form of higher prices on their end to kind of help boost those margins. But for the time being, maybe they're saying, okay, if we can keep our prices in line and eat the margins for a month or two, hopefully this kind of evens out a little bit, but we'll see.
Yep.
As we mentioned, the sentiment has been pretty bearish. Small business optimism, the NFIB, National Federation of Independent Businesses, that optimism index is now back below pre-election levels. So after the election in November, it jumped a couple of months and now it's retreated back to below those levels. So I think businesses were clearly happy with the outcome. They like the kind of net lower regulatory environment that the Trump administration was expected to put in, which has been, for lack of a better term, trumped by the tariffs. They like the deregulation, but the tariffs have been overhead, massively net negative. So these companies have a lot more uncertainty. As you can see that in CapEx plans have deteriorated. The actual sales figures improved, but do remain net negative while sales expectations for the next couple of months declined. That's not great. And on the right there, you can see this is prices. So we've focused a lot on this because tariffs show up in the prices and that feeds through to inflation. and fewer firms reported raising prices recently, and fewer plan to raise them in the coming months. That's a good thing for for inflation. As you saw in the previous slide, not so great for margins if they're going
Right.
to eat some of that price increase on the input.
Yeah, and one of the concerns that we had highlighted was rising inflation expectations. So seeing this does offset that a little bit. There's always the concern that higher expectations bleed over into actual higher inflation readings. And one of the ways that would happen is if small businesses decided to start hiking their prices and sort of letting that belief flow through. So to see that it's not is definitely a good sign.
Yeah, you kind of get the what causes higher prices, higher thinking of higher prices
Yeah,
causes higher
exactly.
prices, and then what's the best cure for higher prices is higher prices. So hopefully we're not going to just be stuck in a higher prices cycle here. Continuing forward, we've got retail sales as well. There was a lot of macro data this week, so we haven't, kind of gone into as in depth on some of these pieces as we have in the past.
Yep.
And that should shift. That's kind of based on the calendar and what have you. But to continue, retail sales moderated a bit in April. March's numbers were revised, I think, slightly lower, but nonetheless, it was a big surge, and that was clearly consumers front running those tariff announcements where
Yep.
they thought, okay, if I've got this purchase that I've been thinking about for a month or two, and I'm not sure on the timing, I'm going to pull the trigger and do it now, rather than wait till April, May, June when they might put a tariff increase on me. So total retail sales were up 0.1%, 0.06% month over month. The core was up 0.2, call it, as they rounded off a little bit. Bars and restaurants saw the biggest monthly gains, while Spartan goods stores declined the most. The year-over-year figures were little changed from the prior month, with total up 5.2 and core up 5.4. And they've been in basically a choppy uptrend since early 2024. And we'll see, if that changed. Again, 1 month you can't tell, but we'll see if this uptrend continues or abates. Hopefully it continues. We'll see with the tariffs here. On industrial production, we saw that inched down. Well, it was basically flat. It was down 0.01% month over month, but it did miss forecasts. The year-over-year figure ticked up to 1.5, while manufacturing output was down 0.4, mining down 0.3, while utilities jumped 3.3 month over month, driven by higher demand for both electricity and natural gas. On the right there, we show capacity utilization. That's been in a pretty steady downtrend since, over the last couple of years here. And we may be seeing that bottom out and start to move higher. Again, it's kind of choppy, as you can see, but we've seen a couple more up months than down months the last 5 or 6 months. And that will be good to see coming back and kind of upping that utilization. Part of this is also plays with efficiency, though, in that when you get more efficient machines, technically you have overhead or capacity that you're not using. If you have, call it a 20,000 square foot factory, and 10 years ago, you needed all 20,000 of those feet, right, to house your machines. And those machines have gotten more productive either because they're able to do more per machine or they're faster or what have you. Then you can use a smaller either fraction of that space or time. And that can result in a capacity utilization decline because it looks like you're operating at a lower utility. But it's not necessarily the case. Your output could be different. Although we saw here output was down. So that's not the case this month, at least. But that is a kind of dynamic to read through on these figures. Moving forward, a bigger piece that was watched this week was the import and export prices. And so far, no big signs of tariffs showing up in the import or export prices. Import prices were up 0.1% month over month. Exports were up 0.1 as well. Although these were both above forecast. So it's worth noting that people thought these were going to be down, actually, and they were up. So not huge increases, but there was a delta between what people thought would happen and what did happen, which is perhaps indicative of some of those tariffs showing up in the prices. Again, on an absolute level, not huge increases, and the year-over-year figures actually decelerated. Import prices are flat year-over-year, and export prices are up 2%. So we'll see if that, again, that's been in a similar upward trend over the last couple of years. We'll see if that's rolling over or if that ticks back up into its uptrend going forward.
Yeah, and it'll be interesting to see what next month's reading has, considering that this is probably reflective of a lot of data before big tariff announcements came out. So it'll be interesting to monitor.
Also got housing data this week in the form of housing starts and building permits, both of which came in short of forecasts. Total housing starts ticked up to roughly 1.4 million units, while, funny enough, permits slowed to 1.4 million units. These are driven mostly by single family, and they can be influenced in the short term by the multifamily, but single family is really what drives the bulk of the housing market here. The issue is that high mortgage rates and inventory levels continue to weigh on the housing market, so you're seeing sideways to downwards chop. The blue line is the total line in both of these, and as you can see, they've been flat to down. So this until you get some of that kind of inventory to clear out or any relief in rates, which certainly doesn't seem like it's coming in the next month or two with what rates have done so
Yeah.
far, we will continue to kind of have just lackluster housing data. We get existing and new housing sales next month, and we'll see if those show any sign of change. But generally, starts and permits lead starts, lead sales, because that's just the steps in the process.
Yeah.
So we're not expecting anything gangbusters in those. But again, we shall see where that data comes through. We also got the preliminary reading for the Michigan Consumer Sentiment Index. That fell further in May. The headline index dropped to 50.8, which is just a solid miss versus 53.4.
Yeah.
It's actually the second lowest reading ever. This data goes back several decades, so that's pretty significant. Behind only June of 2022. Consumer expectations fell to 46.5, which is their lowest since May of 1980, and current economic conditions declined to 57.6. Those are on the left. On the right, you can see inflation expectations, which we touched on a little bit earlier, and those continue to rise higher, with 1 year at 7.3% and the 5-year expectations at 4.6. I think probably the best thing to take away from this is, really there's only one way to go but up for the sentiment. At least
Right.
that's kind of what we've thought. It's continued to go lower
Yeah.
amazingly, but you got to figure at some point, second lowest reading ever, it's probably going to turn. And then the other thing with the 1 year and 5-year expectations at their highest levels in decades is it's a lower bar for inflation to actually hit.
Yeah.
In
Absolutely.
terms of, if people are expecting this and it comes in at 5 or 6, that is better than feared, which we've seen in a lot of the data the last couple of months. It's been better than feared, which isn't necessarily a good environment to be in,
Right.
but better than feared is certainly better than worse than feared. And it's also worth noting inside of this, we look at the difference between Democratic and Republican sentiment lines, and you could see after the election, Democratic sentiment tanked, Republican sentiment
Yeah.
surged. It really just is very obvious when elections occur and who wins the election based on that
Right.
sentiment. But you're actually seeing that Republican sentiment start to deteriorate as well, which means these tariffs and the uncertainty in the markets is really weighing on everybody's psyche, everybody's sentiment, not just one political party being insulated saying, oh, well, our guy's in power, everything's okay regardless of what's happening.
Yeah, I mean, it has been pretty politicized up until now, so it's interesting to see that spread sort of start to close. On the inflation expectation side, this is what I touched on earlier, the concern that might bleed into actual inflation. For now, the difference is still pretty drastic.
Yeah.
And another thing to consider, which I touched on with another data point earlier, is that this data is gonna naturally be slightly delayed. So as we've seen in recent weeks, sort of more positive tariff-related news, next month's reading, we would hope to see that number come back down.
Yeah,
Um,
we'll see on that. But again, given that inflation is now at 2.5%
yeah,
and expectations are for 7.3 in 1 year,
yeah,
that's an enormous increase in
some
1 year. So
yeah,
I think that, as we said, the bar is very high, and
right.
hopefully we can just kind of waltz under it
Yeah,
without much issue. In summary, you can see CPI and PPI came in below expectations, but so did sentiment and housing, and retail sales did beat a bit slightly. They were up a bit. Import and export prices again not showing any big tariff impacts. And the housing data is, yeah, the elevated mortgage rates and high inventories continue to weigh on them. We'll see if the final reading of Michigan gets revised higher at all.
mhm,
The weekly stuff is out as well. Next week you get the AAII and the bull, that's the bull bear, and that's the investor weightings. But those are kind of the sentiment levels for being pretty bearish, and we'll see if those start to turn around after this busy week of data last week.
yeah,
We have very little data out this week.
yeah,
We get the MBA weekly, we get unemployment claims, which is probably the most largely watched one this week, and then you get
yep.
some existing and new housing sales. So we will see on those. But for the time being, we'll sign off. Thank you for joining us weekly. It's Alex Varner, Bay Management.
and Alex Dippery.
Have a great rest of your week.